Hello, everyone, and welcome to our AMA on crypto taxes. My name is Clinton Donnelly, and I'm the CEO and founder of Crypto Tax Audit. And I'm really excited to have with us today two of my directors. We have Sarah DePino, who is our director of tax, and she's formerly with Deloitte and Touche, and I guess it's called Deloitte. And she's had a lot of experience. She's worked with me now, I think almost we're starting for 8 years. And also with us is Ben Weber, who is our director of crypto analytics. And Ben is a recognized expert in the field of the analysis of crypto data for tax purposes. And he's got an incredible team that's been around. They've been working for us a long time, in-house forensic accountants and crypto analysts. And he's done an amazing job. So I'm really excited to have him on the call today to answer your questions about taxes and crypto analytics. Before we get started, I should mention that, as there's a lot of people been calling us up about scam reporting and on your taxes and some things like that. So I want to let you know that if you're at the last minute figuring out what to do with your taxes, certainly you need to be thinking about maybe filing an extension. It does not attract audits or anything like that, but it's a very good thing to do. Pay any estimated taxes you might have, but one thing that we're offering that a lot of people are excited about is our product called Tax Shield. You can see it on our website, cryptotaxaudit.com, and it's for a small amount, $495 a year. We actually monitor your IRS accounts, and we can see in advance if the IRS has selected one of your tax years for an audit. We can see that about 2 to 6 months in advance. And if so, we'll let you know right away, and then we can have a strategy call with you and map out a strategy for addressing what might be lacking. So I think, a lot of people are saying, what do I do about past years? Well, one affordable thing to do is just simply to monitor. And then if the IRS starts an audit, then we can act at that point in time. But why throw good money at bad? So anyhow, at this point in time, I think we'll get started with our team talking about orientation to tax and crypto. But if you would please, I'd be very grateful if you would hit like or subscribe and follow whatever platform you're watching us on. This is a live broadcast. I really appreciate that. It means a lot to us. So first of all, I think a lot of people that call me up have questions about how do I calculate my crypto gains? And I thought maybe, Ben, you could kind of give people the high view of what's involved with that.
Yeah, absolutely. Thanks for having me. I'm excited to talk about this. So, to calculate the gains and losses for each tax year, you really need to start with all the data sources for all years that you've been in crypto. So that includes your transaction histories from the exchanges, centralized exchanges that you've used, and your wallet addresses that where you've transacted on the blockchain, whether that's swapping or just staking or just holding. We take all of that data and we put it into a software to reconcile the transactions. And we go back from the first date that you started in cryptocurrencies. And this is because we need to start tracking your cost basis. For example, if you bought Bitcoin in 2017 and you sold it in 2024, we need to know how much you purchased that Bitcoin for in 2017. That's why we need all of the data for all years. And we take all your transactions, we go through them, we classify them for, if there's income, maybe you have staking income, or if there's trades on your centralized exchanges, or if there's swaps on the blockchain, or even if you've purchased a coffee with Bitcoin or another cryptocurrency. We need to classify all of those correctly for your tax return. Each of those classifications might have a different tax impact, and it's important that we get those correct. And going back all years, so that even if you're only reporting in 2024, we're getting that cost basis from prior years tracked correctly, so that your gains and losses are correct in the current tax year, if that's 2024.
Thank you very much for that explanation, Ben. I appreciate it. I'd like to ask you, Sarah, if you could kind of give the high level overview of what people should think about when they're doing actual tax return and what some of the concerns are that people talk to you about.
Sure. Thank you for having me as well. Excited to be here. So my team obviously works very closely with Ben's team, because once all of those calculations are done, you then bring it over to your tax return. And in addition to all the other tax documents, we add in the crypto portion. Excuse me. So we just want to make sure we are reporting. So that's where you'll get into trouble for underreporting. So to the extent you have trading gains and losses, we will put that on Schedule D. As Ben said, if there's other types of income, so your staking rewards or other income, will go on Schedule 1 as other income. If you're doing, if you have self-employment income that you've been receiving payments in crypto, we will file Schedule C, get all the related expenses for that, which would also be like mining. And we also have a couple of unique things that we add to the returns just to put you in a, conservative spot with the IRS. So we have some special disclosures we add to talk about the crypto. And of course, one of the first things, we always check the box to answer yes, that there is crypto in this in the return. I know one of the questions that we had come through was asking about checking off that box. And while it's not the sole indicator if they're going to come after you and be able to peg you for something, it is obviously good practice to just be open and upfront with the IRS. I think we lost Clinton.
Yeah. Just to piggy off that, with the self-employment income, I do see a lot of people, receiving this, and that's, very important to report. And that's one thing that we would handle on the crypto side. If you're getting paid in cryptocurrencies, we would correctly classify that, hand that over to Sarah's team so that they can report it on the tax return.
Yes.
So I think we can get started with some questions. I sold some crypto in 2025 on Coinbase that were bought on Coinbase back in 2019 and 2020, and then transferred to my ledger and then back to Coinbase. The issue is that I don't know my cost basis. Please help. So this goes back to what I was saying with when I was describing how to do, the crypto calculation at a high level. And this is, you're going to need to go into your Coinbase account, get your transaction history from 2019 and 2020 that shows all your purchases for your cryptocurrencies. And that will be the cost basis that you will assign to them when you're reporting in 2025 for the sales. You'll also need your Ledger wallet addresses, and you can upload that into a crypto tax software, or you can have a crypto accountant do this for you, like us. We'd be happy to help. And you have to reconcile your transactions from 2019 all the way through 2025. And the software or your accountant should be able to give you a nice, clean report that shows your gains and losses with the correct cost basis. How should one deal with estimating losses from incomplete records, which may span multiple years? For example, losses incurred on Harmony One chain and its uninterpretable block explorer data. You may need to, go back and restructure these records. I deal with a lot of people who, they use Binance or KuCoin and they got kicked off and they don't have their transaction records. And so you might need to do an analysis to see how much you put into those exchanges or onto Harmony One and see how much you took off. And the difference might be the loss. And so that's one way that you could restructure these records. In this case, the best thing to do is to go to an expert who's dealt with this before. Like us, I've seen this, with a lot of different clients. So it's not something unusual for me.
We do get that a lot. All right. In the past, I could handle my yearly tax reporting and form filing, but now with crypto, I'm in way too deep. That is honestly, we hear that a lot. People may file using TurboTax or their own software, and then they get into crypto and it turns into a messy web of transactions. And that is obviously where we can help. So, Ben can help sort through the transactions, or if you have those and you only need help with the tax return, we can also assist with just the tax return and have you upload all your information to us, and we do the filing for you to make it super easy.
Yeah, I think a lot of people, they get into the situation where not only is calculating the gains and losses complicated, but also, where does it go on the tax return? There's a lot of, uncertainty around that when you're filing your own tax return. And just as Sarah said this at the beginning, but when you're reporting income like staking and crypto rewards, those are going to go on Schedule 1 of the tax return. And then all of your gains and losses are going to be reported on Form 8949, Schedule D. So that's where you'll report those on your tax return.
Is a single member LLC allowed to file an extension? How does an individual who is a single member LLC report the income and expenses from the sale of stocks and securities? So we actually do get this one a lot. A single member LLC by default is a disregarded entity. So if you file an extension for your 1040, your single member LLC by default has an extension. If you choose to be taxed differently, like an S Corp or I guess if you even said made a C Corp, that would be something different, and you would have a whole separate business filing. But to the extent you are a single member LLC reporting on your 1040, the extension you file for your 1040 extends to that as well. The income and expenses from the sale of stocks and securities are still going to go on the same place unless you fall into trader. Well, even if you fall into trader tax status, you still will report the trading activity on that 8949, which rolls up to Schedule D. If you do qualify for trader tax status, you might perhaps be able to take some expenses against those. But by and large, most people are considered passive investors and are simply reporting the same way they would if they did not have the LLC in place.
Yeah, I get a lot of questions. A big one is setting up an LLC and trading in it and, taking expenses. What are your thoughts on that, Sarah?
I think even, you still have to look at the underlying activity. So it really is going to depend on that trader status. If you're a trader, then you can even go one step further to make that mark-to-market election, which gets a little complicated, and it's probably the much more savvy investors that are dealing with that. But by and large, if this isn't your full-time job, it's typically just going to fall into that passive investor category. Obviously, everyone's situation is unique, and we can deal with all the one-on-one conversations to see what the best fit for any specific client is, but that's just what I've noticed.
My last two returns were done via Zenledger. It shows a $38 balance, but asset counts are way off. How do I fix this? So when you're reconciling all your transactions, whether it's in Zenledger or Coinly, CoinTracker or CoinTracking, and any of these softwares, it's important that you are including all of the information that you need. So all of the trading data. If your balances are off, it's likely due to two reasons. One, your trading data, you haven't included all of your trading sources, maybe all of your exchanges or all your wallets, or Zenledger isn't pulling in the APIs correctly for certain blockchains. I've seen that happen, not on Zenledger specifically, but on all of the crypto tax softwares. It may also be because of not classifying your transactions correctly or not reconciling them correctly. So you have to make sure that you've imported all of your data and it's there, and that all of the transactions are classified.
Oh, this is going to be a Ben question.
I took a 1231 snapshot, but realized verifying balances needs more than buys, like staking rewards, converts, going back years. Is this right when preparing the allocation report? So the allocation report is for the safe harbor. It's to transition taxpayers to the new IRS regulations, which mandate that taxpayers use the by account or by wallet method for tracking cost basis. The previously many taxpayers, I would say probably like 90 to 99% were using the universal approach where they treat when tracking cost basis and calculating gains, all of their accounts and wallets are treated as one account for the purposes of calculating the gains and losses. When doing the snapshot, you're just taking a inventory of your assets at the end of the year, which shows how much of each cryptocurrency you have in each wallet or account. The next thing you need to do is reconcile all of your transactions all the way through December 31st, 2024, and create a list of unused cost basis, or what I call a closing position report. And this report shows all of your holdings, the cost basis to all of your assets, and the purchase dates. Then you need to do an allocation to allocate that cost basis to what your actual inventory is in your snapshots. And this allocation should follow the safe harbor plan that you adopted. If this is a service that we're offering for this allocation plan, we have more information on this on our website. And we've also done a previous AMA on this, I believe 2 weeks ago, that you can watch to learn more about it. But if you need help with the allocation, we're absolutely here to do that for you.
I want to learn the best way to calculate my crypto taxes for 2023. Okay, and then you might want to roll that into 2024. I'm assuming you mean calculate the crypto or do the crypto reconciliation so then you can include those results into your taxes appropriately. I'd say schedule a consultation with us to talk about your unique situation.
Exactly. Every situation's different. Learning to do your own crypto taxes is great. It can be complicated as well. If you find that it's becoming too difficult, talk to a professional like us.
Do I have to report losses from Celsius payback? So everyone's Celsius, we get a lot of Celsius questions, and everybody's situation is a little bit different. It really is dependent upon what you had, your basis in the assets you put into Celsius, and then what payments you received as part of the bankruptcy payouts. So the calculation can really vary from person to person. We've actually seen some people end up in a gain position, even though at fair market value, they lost a lot, but their basis was so low that even when they got some of the payback, they still had more than what they had as basis into it. So if you are in a loss position, I would definitely recommend reporting the loss because that's only going to help you to offset future capital gains. So I would say you would want to report it.
Yeah, absolutely. You definitely want to catch those tax benefits. And this goes for BlockFi, Voyager, and other similar cases where users of these centralized exchanges lost money and even got distributions back or compensation back from the exchanges. and they can be complex calculations that, and every situation is different. Some are simple, some are more complex than others. It depends what assets you have in there and what assets you're getting back. For example, if you for Celsius, the users received Ethereum and Bitcoin back. But if you had another token like Chainlink in there, and that's the only token that you lost, there's going to be differences than somebody who just had Bitcoin or Ethereum and Celsius that was lost.
Welcome back, Clinton.
Well, somehow my internet went down and my laptop decided that was a good time to load some updates. But anyhow, hey, I wanted to just make a comment, and I know you guys are enjoying just the amazing knowledge that Sarah and Ben have. But I talk to clients on the phone, and a lot of them have fear that they haven't reported their crypto income correctly in previous years. A lot of them say, "Hey, I never went to anything. I went to cash. I reported, but the intermediate gains along the way, I never reported." And also people are saying, "I always check no on that cryptocurrency question," and they're worried. And you can fall into a downward spiral of, "I didn't report this year. Why should I report now?" And one guy I was just talking to it today. He said, "I'm afraid to report because I'm going to have to say that I bought certain coins back in 2021, 2022. Won't the IRS see that? And then they'll come after me for those past years." And I want to answer that broadly because I think a lot of people on this call may have this problem. Well, first of all, the IRS data mining techniques are not that sophisticated to go after the cost basis states. There's just a lot of limitations, and that's not something that we've seen them do. The second thing is that the best thing you can do if you haven't been reporting correctly in the past is to start reporting your crypto income correctly for this year, for the 2024 tax year. Do it right this year. And you can, if you want to go back and amend prior years, you can. What we have found is a bit more significantly more cost effective is to become a Tax Shield member. We monitor all the past years, and we'll see a flag if the IRS is actually starting an examination. We'll see that flag 2 to 6 months before it happens, which gives us a chance then to go back and correct those years. So there's no, so we think this is kind of like a real efficient way to start to help you move from non-reporting to becoming compliant. Watch your back for you until those years age long enough that the IRS isn't going to be coming after them. So if you are paralyzed and you're afraid about having not reported in the past, I just ask you to commit to just doing it right this year and start moving forward. In fact, the courts look very favorably on people who shift into an integrity mode. So if you have any questions, you can always set up a call with on our website. Go to cryptotaxaudit.com, go to the contact page, set up a call with me. We can talk confidentially about your situation. All right. Do we have another question?
I want to add to that last point, Clinton. I think it's absolutely necessary if you haven't even calculated your gains in the past. That the first step is to go back, figure out what the damage is, how much income did you make, how much did you have any losses, and with that knowledge you can make informed decisions on what to do moving forward. Absolutely. And one thing that you and I've done, Ben, effectively with other clients for a variety of reasons, a lot of times because of the time constraint, we have to report something to the IRS, or they call us up and they say, "Hey, I had one guy, he said I was using TurboTax. They said I owed $140,000. He said, "Clinton, there's no way I owed $140,000. So I asked him, "What do you think you owed?" He said, what do you think your gain was? He said, "I think about 90,000, so it was 50,000 high according to TurboTax." I said, "Well, look, if we do the gain calculation for you, we typically charge, for the vast majority of our clients, we charge right now approximately $3,300 to do the gain calculation." Now, that sounds like a lot of money, but if we can reduce the calculated gain by $10,000, then the tax impact
state and local level completely pays for our full service gain calculation. And the fact of the matter is, actually, I'd like you to comment on this, Ben, is when people who do their own gain calculation, do they tend to come up with a low number or a excessively high number compared to what we would come up with?
In general, higher. That's what I think, because things aren't classified correctly in a lot of softwares. If you don't classify withdrawals and deposits as internal transactions, the software will think that the withdrawal is a disposal that shows up on your 8949 report, the capital gains report. So you're reporting disposals that never happened, and that that will increase your tax liability. And also, if you're not capturing losses correctly, that's just one area that you're kind of shooting yourself in the foot. You can get losses for the future or for the current year to take against your capital gains from stocks. So there's more than just gains out there that you should be concerned about.
It's absolutely true. I mean, when you have good people doing the work for you, even though you're paying more, they actually pay for themselves, just as we described. And Sarah, you and I have talked about this. I mean, we charge a fixed price for a tax return, roughly $2,900, and a lot of people go like, "Oh my gosh, I could get TurboTax for $100." Yeah, but the fact of the matter is, you're going to be paying more. All right. And TurboTax is fine if you're simple. And TurboTax is aimed for people who make under $100,000. That's their sweet spot. Although it can support people making more, it's going to leave you open to risks of paying of paying too much tax. They don't care if you pay too much tax. So our services pay for ourselves. A good tax return pays for itself. What are your thoughts about that, Sarah?
Yeah, I agree. I think understanding your tax return and having good inputs to go in. So in combination with, with a good calculation, you are going to only pay what you need to pay and not anymore. And that's usually what people are. I mean, obviously no one wants to pay tax, but they don't want to pay a penny more than they need to. And I think having a good preparer allows you to be in that spot where you feel good about it. You're paying your fair share, whatever you owe, and you're not giving the government any extra.
Very good. And I should mention to everyone, we have a course on our website that we offer free to people to learn how to prepare their own tax return, and a crypto tax return with the way we do. And, if you're on a budget and you just want to do it right and make sure the IRS isn't on your back, you can take the class. We recommend a software you can use. It's a free software that'll do just about everything you need. And you can learn how to do your own crypto tax, how to report it in a sophisticated manner, and it's there for free. We just do that for the greater crypto public to be giving back. So those are just some comments. Now we have a question. You say IRS letters 6173, 6174, and 6174A are phishing for info, but your site says you can see my IRS account if I pay. Don't know what that means. So which is it? I thought the IRS didn't know, and what was phishing? All right, let's talk about this. The IRS developed these three letters, and the three letters, 6174 and 6174A, are two versions of the same thing. One is actually a little bit longer letter talking about how you report your crypto income. What's different about Form 6173 is it says the same thing as 6174A, but it also asks you to fax in a signature on what we call a jurat statement, which says, under penalty of perjury, I vouch that my return is accurate, complete, without errors, and you have to send that back. So that's what they're asking to do. Now, what's going on here? The IRS has used these letters before, back in 2019, when they were phishing for large crypto traders. In our experience, they actually knew who the large people were. They sent these letters out, and they came from the large business and international division of the IRS. And they're now sending out more of these letters now. It started in December, and we've determined that the reason people are getting these letters is because they were traders on Binance International. at some point. You may recall the IRS or the U.S. government filed suits against Binance International, and they were substantially found guilty, and eventually CZ and Binance settled out of court with the government. CZ agreed to go to jail for, I think he was there for 4 months. And we believe as a part of that Binance turned over all the data that they had on anybody that they could connect with being U.S. clients. And I don't know the exact detail how they turned that over, but it would be unthinkable that the IRS would let them get away without having to turn that data over. As most people know, Binance was running a no KYC operation. A lot of people, back in 2017 and 18, almost everybody had a Binance account. So they turned over all this data. What we're seeing now is that everybody who was a Binance client is getting one of these letters. Now, we're talking millions and millions of clients, U.S. clients, but the IRS is phasing these out. What's happening is they're taking, here's how it happens. So let's say you bought Bitcoin on Coinbase. You then transferred that Bitcoin to Binance to buy your favorite coin. Because, back in 2017, 2018, the only place you could buy them was on Binance. So you've moved it there. So Binance doesn't know who you are, but they do know the address from which you sent your Bitcoin because they received it. And now if that address, then the U.S. government can take that information, map it against addresses, see that it's a Coinbase address, and then they can go to Coinbase, a U.S. entity, and through subpoena power, they can obtain who the identity information is of that. And then from there, they then send a letter, a 6173 or a 6174, saying, we think maybe you didn't report all your crypto right. Now, that's a phishing expedition. They didn't look at your tax return to see if you reported crypto. I talked to a client and said, hey, I reported all my crypto. Why am I getting this letter? They aren't looking. They're just sending these out. Now, the IRS can only afford to send out so many of these letters at a time because each letter generates a response and some level of demand back on the service. They either have to respond to phone calls or letters like that. In the past, we've seen them issue these at a rate of 10,000 a month. So that's what we're seeing. They're being issued on a monthly basis, and lots of people are getting these. What do you if you get one of these letters, I recommend that you contact our office, speak with me or Kent, my director of tax resolution, and discuss your situation. For many people, the correct solution is to do nothing. But for other people, we need a more sophisticated strategy, and it's a great time for you to talk to experts about how to plan that. But it is a bit of a phishing expedition because they don't know what's out there. If you don't respond, then the burden falls back on them to decide if they want to initiate an audit. So, the IRS is limited in how many audits they can kick off. Audits of crypto are actually quite expensive. Our company has done over 50 audit defense of cryptocurrency reporting. I think we're the largest in the entire United States in terms of crypto defense. We've also taken 5 cases to tax court. We've won 3 of them. One of them, the IRS hasn't thrown the towel in yet, and the 5th one we just filed. But so we just let it be known. Crypto tax audit is known in the hallways at the IRS counsel's office. So we are the ones that can help you understand where your risks are and how to plan a response. If you have any questions, please schedule a call with us. If you have one of these letters, you should take it very seriously. Next question. What is the tax difference between cashing out crypto to USD versus stablecoin and then using those funds for dividends or stocks? Well, who would like to take this one?
Well, I can.
Okay.
I mean, if you're cashing out your crypto to USD, obviously there's a taxable event right there. Just as if you traded crypto to crypto, there's another taxable event. And then you use the funds for dividends or stocks. I'm assuming you're buying stocks. Now you have a whole new purchase and a whole new cost basis. So you're just, start the next cycle on the new stock you just bought, and you'll either hang on to it and after you buy it, there's no immediate tax implications. If you get dividends from it, obviously those are going to come to you on a tax form. And then if you sell it, you either have a gain or loss from that point. But the initial cashing out your crypto creates a taxable event. If it's USD to stablecoin and it's a roughly a 1-to-1 ratio, you still want to put it on there, because the IRS sees that proceeds. They don't know your cost basis. So especially in the crypto world, they will see the proceeds number and they're going to assume that you have income. And since they don't know the cost basis and they don't know that it's pegged to the dollar, they're going to just think you owe tax on whatever that dollar value was. So you should still report it and then show the cost basis, even if it's zero, and then go on to move to your next investment. Or even if the gain's zero, sorry.
Make sure that when you cash out to USD, before you start, investing that money to calculate your, the tax liability from those gains when you go from crypto to USD. That way, if you don't have to liquidate your stocks to pay your tax liability. And if the stocks go down, then you may have lost all the money that you had, to pay your tax liability.
That is a great point, Ben. I was just talking to a person on the phone today, and he expected he owed $250,000 in taxes, and he had like $350 in cash. So he felt, he could pay it now, but he felt that he would probably rather like gamble it in the crypto market because he thought it would go up before he'd have to pay later on. I said, well, you have interest costs on that and penalty costs. But I said, the question really comes down to, what do you think you'll do better or worse than what the interest rate is, which is, works out to be like, in his case, be roughly 8%. So, and it's a serious issue. And I know a lot of people who have done serious harm to themselves by gambling with their tax money. And, if you're going to gamble your tax money, don't gamble with all of it. I suggest that he split it, but really, I think don't. You just got to accept the fact that, you're not getting as much as you can, but you're not going to have a nightmare. I mean, what if all of a sudden your values dropped and you're forced to liquidate, which is the problem. You're forced to liquidate to pay the tax bill. And great point. Next question. Can Tax Shield be used regardless of if you've done your taxes or not? Absolutely. I'll tell you about a client of ours. He started trading cryptocurrencies while he was in college. And when he was in college, his dad was doing taxes and reporting his income, not the crypto income, but so he never filed a tax return. And then he'd gone for like 6 years, and all of a sudden there was an audit flag set. He was a Tax Shield member. An audit flag occurred on the year 2018. Kent, our director of tax resolution, spoke to him about it. We discussed what it was. He went and found out from the IRS why the audit flag was generated. We quickly developed tax returns for his years to report his crypto income, filed them, and he didn't have, the audit completely got canceled. So that's, the last thing you want is to have your face on an auditor's dartboard. It's really key. And talking about auditors, I think it's worth commenting because there's a lot of turbulence going on with the state of taxes in the U.S. There have been layoffs in the IRS, but at the same time, they have been hiring aggressively in the past couple of years. So they let go of 7,000 probationary employees. Many of these were auditors, but it takes a long time to become an auditor, quite honestly. So they weren't losing the best talent, right? The best talent is still there. And the IRS has been refocusing their efforts. It had been a couple of years ago that over half the audits were occurring on people whose income was less than, $400,000, actually even far less. And they have now refocused their efforts. They're not going after the lower income people. They're going after higher income. Higher income to them is defined as your total positive income, which is all your wages, all your 1099 income, and the proceeds only from your crypto trading. So what is happening is that's where the remaining auditors are focused on the high-end people. And let me just tell you, this pretty much includes any crypto trader who's engaged in any active level of trading. So this is their sweet spot. This is where they're focused at. So when you hear about auditors being let go, the last place they're going to let go of is in the crypto space. And the fact that they're issuing these letters is an indication that this is still their focus. So by all means, I think everybody should consider Tax Shield to watch your back and make this the first year you're totally compliant in your crypto reporting.
Yeah. Hey, Clinton, just to touch on that, someone was asking, they intended to say if Crypto Tax Audit has done their taxes. Is that a requirement of becoming a Tax Shield member? To which the answer is no.
Correct. Anybody can be a Tax Shield member.
And while actually, only because I just peeked at the chat and saw this sort of follows up with it with the statute of limitations. So the IRS generally has 3 years to audit you if you have filed complete and accurate returns. If you have a material misstatement of income, so 25% or more, that window opens up to 6 years. And of course, if there's fraud and non-reporting, there's no statute. They can go back and look at what they will.
All right, Ben, I think that question's yours.
Yep. Are you able to use Coinly, or would we be forced to migrate our data to another software? I don't like CoinTracker or CoinTracking. So if we are doing your crypto calculation, we're going to do it all in-house using the software that we've chosen, which is CoinTracking. And what we do is we take all of your data once you've handed it over to us, and we do all of the work. And we will reconcile it from beginning to end. We have a team of analysts who do this. We have stages in place to make sure that it's done correctly. We have a detailed review stage to make sure that all the imports are correct, all the classifications are correct, and then all of the calculations go through me for final review to make sure that everything is in order and that nothing was left out. So we do all of this in-house, and we don't typically work in our own clients' Coinly or CoinTracker accounts.
That's interesting. When I talk to people who are working with other companies, they tell me, yeah, my accountant has a guy who does the gain calculation. It's always a guy. I'm not talking about gender. It's just they have one person and his skill set's limited. Here we have an entire team of highly trained, multi-year experience in doing this. And what Ben has developed for our company is a repeatable process and training methodology. And we have an analyst do the work, and then we have a reviewer who reviews their work, and then Ben looks over all that work. And there's 3 levels of review. You're not left to one guy and whether he made a mistake or not. There's reviews and reviews. And as a result, we have of this repeatable process, we're able to actually fix price our gain calculation. When we basically size people into 4 categories. When they talk to us on the phone, you're either small, medium, large, or ugly. And that's where everybody, and the ugly is really surprisingly low. I mean, our ugly price is $12,000, to be honest. And I have talked to clients who have been literally milked by other gain calculation services, even online services, where they're spending $20,000 to $30,000, and we go back and look at it, and it's just chock full of errors. So because they just don't have a repeatable process, they can't fix price it. In order to fix price it, you got to know what you're doing, and that's what Ben's team does. So that's good. The fact that we use CoinTracking doesn't mean that's just what we use. That's because we know it's a good workman knows his tools. That's the process. Next question. Ben.
Mined ETH in 2017-ish and just moved to Trezor. The cost basis is a concern. So in this case, I'm assuming that there's some missing data, and you're going to need to restructure your transaction history and maybe use an estimated cost basis on that ETH. So if you mined the ETH in 2017, you don't have those transactions, but you moved it to your Trezor. Generally, there's 2 things that happened. You're either moving it little by little to your Trezor as you were mining it. In that case, the cost basis is going to be the value of those ETH on the dates that you received them. And you are supposed to report those as income when you receive them. So there should be income being reported in 2017. The other method is if you kind of lost your your records, and you have one transfer into your Trezor, you could claim all of that as income. If you transferred it all into Trezor in 2017, as a lump sum, that could be the income and the cost basis. Or you can assign a zero cost basis to these transactions, as you likely didn't report in 2017. So you never reported the income, and you don't have a right to the cost basis. So it should be zero. So you either have to go back and restructure to amend 2017 to report that income, or you can leave it as a zero cost basis.
All right.
I've been harvesting losses since 2022. Can I use them to offset both short-term and long-term gains? Are they limited to just long-term capital gains? Sarah, could you take a
so
stab at this one?
When you are carrying over capital losses, any of the losses will first get applied to their original category. So if you generate long-term losses that you end up carrying over, and then in the next year you have both long and short, first it's going to wipe out any of the long-term gains. And then to the extent you have leftover, it will go to the other, the opposite category, and it will start to reduce your short-term gains. And then obviously, if you wipe out all your gains in a given year and you still have more losses, you're capped at that 3,000, and then you'll continue to carry forward the rest.
Very good. Hey, everybody, I want you to stay on to the show because at the very end of the broadcast, I'm going to tell you what I think about Donald Trump's proposals to do away with the entire income tax. I think you'll be shocked to hear what I think about that. So stay posted. What's our next question?
Oh, I think this one might have been sent ahead.
I think this is your question, Sarah.
Yeah. Over 5 years, I rolled funds from my TSP into my iTrust Capital Roth IRA. If I wait 5 years to withdraw and I'm 66, are the rollovers taxable, or are they qualified withdrawals? So they shouldn't be. If you've met the age limit and the time limit, they should not be. And actually, the thrift savings plan that rollover should not be taxable to you.
All righty.
It can also be used to offset the short-term gains would be great, but I'm not sure if that's allowed. I'm assuming that's referring to the long-term and short-term. So you will offset your gains. There's more of a comment. I've been holding crypto for my mom under my name. If I gift it to her so she pays less tax when selling, how should I document to satisfy the IRS? If I gift it to her so she pays less tax, this one might be one of those like we need to discuss a little more. But if you are gifting,
when you gift, if you gift it to her, you're also transferring your cost basis to her. So the cost basis she gets the low cost basis when you gift it to her. So by gifting it to her, it's not, you keep it under the gift allowance, so there's no tax on the gifting, but she still received, is there still a cost basis? Maybe I'm confused on the question.
I'm not exactly sure, but the cost basis does go from the person giving the gift to the person receiving the gift, along with the long-term or short-term status of that.
Yeah. So you're not, so we would say definitely it's not good to be buying crypto for somebody else under your name because it creates an ugly situation. You should tell them to get their own account, force them to get their own account, especially as it starts to become significant. Okay.
And there's really a simple answer to that. You can, get them a ledger or a wallet. Give them that wallet, send that, those Bitcoins or cryptocurrencies to that wallet and hold it there securely.
Ben, this might be you for a determination on a specific date.
Sure. So I got my green card on March 6, 2024 for my first U.S. tax year. How do I determine the fair market value cost basis for crypto I bought before that date, which I'm not required to report to the IRS? So you still need to go back and from the beginning and calculate all of your gains and losses, reconcile all of your transactions so that you can capture the cost basis for assets that you purchased before you moved to the U.S. The cost basis, if you bought cryptocurrencies before you moved to the U.S., that cost basis is going to transfer over when you sell them as a U.S. taxpayer.
Yes. So you get taxed, upon the sale. So we see this even in the reverse. We have several clients that have relocated to Puerto Rico, and we will often have to do this sort of adjustment based on a move date. So this is the same type of concept. So when you sell it determines whether it's U.S. sourced or not. So in this case, you'd have a dual status tax return for that first year, and anything you sold during the time you were not a resident, you were a non-resident alien, you would not have to report it. But
now,
to Ben's point, you still need that cost basis done.
But if I'm not mistaken, the gain that they experienced before becoming a green card holder is not subject to U.S. taxation.
Right, like a mark-to-market adjustment at the
exactly. Yeah, you bought it at 1,000. It's now worth 3,000. When you become a green card holder, you sell it for 10,000. Your gain is not 9,000, but only 7,000 under U.S. tax law, because that's the part you gained when you were a U.S. citizen, and you pay tax on the 7,000. Ben's correct. You calculate the correct gain, but then you adjust it to the green card start date. Very good. What else we have here?
I have a 6-figure investment in XRP. Should I do some preparatory action before selling it for a huge profit, such as creating an LLC or charitable trust?
No. I'm gonna say here's the deal. If you create a single member LLC, one owner, then it's treated as a disregarded entity by the IRS. In other words, it's just you. It's just an extension of you. Even though it's an LLC, it's still you. So when you sell it, it's 100% taxed as though you had sold it. So there's no change on tax. If you move it to an LLC that has multiple owners, well, then now you just shifted that same tax burden to somebody else. So that's not really what you want to do. What about a charitable trust? There are people on the internet, particularly on YouTube, that aggressively push using charitable trusts. They call these charitable remainder trusts. And we have a video on our YouTube site, a Crypto Tax Audit, where we go into this in great detail. And Brad Kimes actually did a video as well, taking our video and comparing it to one of the other guys and just showing the false representations that these people are making. Fundamentally, think about this. To be a charitable remainder trust, you have to give at least 35% of it away to a charity. So how am I going to make more money if I have to give away 35%? Think of it as a tax. I mean, it's not doing anything for me. So I just at a simple level, when you're investing in crypto, tax is pretty straight up tax. It's not like real estate. It's not like other sophisticated investments. It's strictly profit and gain. Well, hey, our time is almost upon us here. And I want to speak to a lot of concern that's out there about the Trump administration, and not just Donald Trump hasn't said it, but his kids have, and some other people. The Secretary of the Interior is suggesting, what if we just do away with income tax altogether? Let me just comment on this. If that happened, let's think about what would happen. First of all, if we do away with the income tax, immediately everybody gets a pay raise, right? You no longer have withholding of the federal income tax. I would assume that Medicare and Social Security would go away too in this proposal. So it'd be a big, immediately pay raise for everyone. That's cool. Secondly, all this 401k, IRA stuff would just go away, because there's no such thing as a tax advantaged account anymore, because there's no tax, right? So this is pretty significant. Now, the moment Donald Trump announces that he intends to have no tax, everybody's going to stop paying taxes for the previous year. I mean, it's just going to be a complete shutdown. The IRS is they're all going to be looking for jobs. That's over. Now, my opinion on this is I think it's a serious proposal. I don't think that proposal is going to be made until 2026. I believe it'll be a very significant topic of discussion in 2026. 2026 is an election year, particularly for the House of Congress. Everybody's reelected in Congress and a third of the senators. And I believe the Republicans will use this as a major campaign theme that why you need to reelect them and not Democrats. Because the Democrats they've pigeonholed themselves into being basically they want to keep taxes high, expenses high, and it's going to be very difficult for them to argue against this. So I believe that the whole tax issue will be held out even until Election Day and beyond. So I don't think we're going to see any action on this until 2027, in which case it'll be a campaign promise fulfilled by the Republicans. So I see this as being a major political leveraging card. I don't believe that they're going to take any action on it until 2027, just because of the political manipulation of all that sort of thing. Certainly, it would be very exciting for almost everybody if there's no tax, because I think it's going to be putting more money in people's pockets. So it'd be an exciting topic to watch. But in the meantime, I do believe the IRS is focused on the high end, which is they've already declared it's the crypto traders that they want to go after. So I believe it's important for everyone to be compliant, get the tax shield product to watch your back, and hope for the best. And I guess vote for people who want to get rid of the IRS next year. So that I want to thank everyone for being on our AMA. A lot of great questions. And I think you also got a sense of the strength and talent of the directors of tax, Sarah, and also of crypto analytics, Ben. And we're waiting here to help you. It's never too late to get current on your taxes, to call us up and put a strategy in place on how you can move from being non-compliant to compliant and to be able to sleep at night again. And I wish you all have significant gains this year, and I wish you the very best. Thank you so much for listening in.